Good morning and welcome South Africa to our first Top Empowerment Masterclass in partnership with Invequity and Signa Group. Today we'll be in talks about the private equity investment as a tool of transformation. Hello, and my name is Tabiso Mishak Mhlabeng, and I'm the marketing executive here at Topcom Media. And today with me, I have top wonderful people who will be talking on this topic, who will dissect it for us so that we can understand what is private equity and what is transformative investing and how we change the narrative of BEE as a business tax, and also how the multinationals can play a role when it comes to this. And lastly, we'll also talk about transformative investing and how it drives economic inclusion. But before I go any further, let me first introduce Boitumelo Tsepu. She's the CEO of Invequity. She manages both the governance and investment teams. Fun fact about Boitumelo, if you don't know, if she's not at work, she likes singing in her church choir and spending time with her family. Boitumelo, would you say hi to our audiences today?
Hi, everybody. Thank you so much for joining us.
Thank you, Boitumelo. And secondly, we have Murray Shabant. He's the CEO of Signa Group. Murray is an energetic and optimistic leader who believes in South Africa and the potential of his people. And I can attest to that. And fun fact, Murray is not a big fan of Kaizer Chiefs. That's one thing you need to know about him. He specializes in the implementation of private equity models, as well as employee and broad-based ownership structures, and supports broader economic broader economic inclusion. Murray, if you could say hi to our audience today, and maybe share a little bit of a fun fact beside Kaizer Chiefs for today.
Thank you so much. And Tabisa, I'm very pleased that only one of us between us is a Kaizer Chiefs supporter. But another fun fact is I also enjoy cycling and have cycled all over the world. And I'm looking forward to a cycling trip next week. So that's another little fun thing I enjoy doing.
Fantastic, fantastic. And we also have Jeff Blunt. I really struggle with saying his name. Last time I called him Geoff. Hopefully he forgave me for that. He's the head of investment at Invequity. He has over 25 years of experience in the investment industry. So we are really, really lucky to have him with us today. As a qualified chartered financial analyst, Jeff has a wealth of knowledge across all investment classes and is passionate about investing. Jeff, if you could also introduce yourself to our audiences for the day.
Well, it's nice to meet everyone. If you're going to ask me for a fun fact, I would say that I try and fish a lot and I catch very little.
Oh, Jeff. And finally, we have Moses Mpofu. He's the director of Riot. And Moses is the network rollout manager at Riot Network. He's a client of Invequity. So what Riot does, it's a network that specializes in the design and development of wireless network equipment that enables the creation of wireless broadband services in rural communities. Maybe a fun fact about you, Moses, and we can keep on going.
Okay. Hi, everyone, and welcome. Thank you for joining us. I enjoy playing around with technology and meeting new people. Yeah, that's a fun fact about me.
I can also say he's an incredibly good golfer.
Yeah, I also enjoy. I got a hole-in-one certificate. I think I was playing at Mahalis Park, and on the 14th hole, I hit it.
Hole-in-one, sure. Well done.
Well done, Moses. Well done. But before we go into the masterclass and start talking, I think let me share a little bit about who we are. As I said, I'm Tabiso. I'm from Topcom Media. So here at Topcom Media, our business is to inspire the world to do good business. And we're really, really grateful to have Invequity joining us to help South Africa do good business, and also in helping those multinationals that are doing business in South Africa to do so. So if you want to know about Invequity is a fund manager, is a bespoke fund manager for various niche private equity funds. If you want to know more about them, before we even start, you can visit www.invequity.co.za. And about Signa, as you know, through the power of one, and the Cigna values, Cigna Group strives to become the #1 impact organization. As you know, what they do is they deliver a complete and comprehensive solution for economic transformation and economic activation. They train individuals, create jobs, and facilitate the development of infrastructure and new business. And so just to start it off for the day, like one of the biggest things when we talk about BEE in South Africa, the topic most of us or most of South Africans, we try to run away from this topic. And you know how the Black economic empowerment is seen by many companies as an additional cost of doing business in South Africa or a tax. Yet, you know, Invequity sees it differently and views BEE as creating opportunity for growth. And how come you see BEE so differently from others? That will be the first question for the day.
So let me take that first. BEE is important for where we are as a country. I think it is very important for our current situation. We know with just the opportunities that need to be made available, not only to our youth, but to just everyone that's living in this country. And BEE is one of those, or how we've taken it at Invequity is we're using the legislation as a catalyst for growth in our economy. You'll hear throughout the masterclass just how the requirements of the legislation are being used to rather invest back into the economy. And we've been able to attract a lot of direct foreign investments as a result of the legislation. So BEE, there's a way of thinking about it. You know, there's a mindset around how you think about different things. And this has been our goal, to use it for the good that it was intended.
Mm-hmm. Murray, would you like to add to that?
Yeah, absolutely. You know, often businesses and business owners are confronted by this very complex piece of legislation called Black economic empowerment. And I think, firstly, there's an unfortunate naming in the legislation, because if we just said that this is South African economic empowerment, it would achieve very much the same goals, because the idea is to bring as many South Africans into the formal economy and with economic inclusion as possible. But if we just go back a little bit in time, you know, in 2004, the BEE Act was passed, and its goal really was is one of the pieces of legislation that was to effectively reverse the effects of legislation that had been passed in the 60s, 70s, and 80s that formally excluded Black people from the economy. So, so we'd had this sort of raft of legislation, probably going back as far as 1910, right through to the 1980s, which excluded Black people primarily from operating in the mainstream economy. And so one of the pieces of legislation to try and redress that was the Black Economic Empowerment Act, passed in 2004. Now, the problem with that act was that it was written very conceptually. It was written as almost as a philosophy statement instead of something really practical that people could implement. But at the same time, government had to hold themselves accountable to making sure that this piece of legislation was implemented. And so what you found is a lot of good practices and a lot of bad practices emerged as people tried to navigate this piece of legislation. And what we found, certainly, you know, I've been in the space since 2005, when the first drafts of the BEE codes were contemplated. What we noticed really from then is that organizations who understood the philosophy of what BEE was trying to do, which was to create economic inclusion, create economic growth, stimulate investment, stimulate learning, those organizations have done really well in implementing BEE in their organizations, and have seen it as part of a business as usual for companies operating in the new South Africa. Whereas for a lot of businesses, and I don't want to sort of make it sound like it's the fault of multinationals, because you know, it's a very difficult piece of legislation to understand. And if you're not part of or live in South Africa, grow up in South Africa, and understand all the dynamics, and now suddenly as an international investor into the South African economy, you're confronted with this piece of legislation, which actually doesn't seem to have a business orientation to it. It can be firstly overwhelming, and then something that maybe you don't want to do. And so what we've experienced over the years is engaging with clients that say, let's look at this piece of legislation, this BEE, as a way of making business sense and enhancing what you do in South Africa. And so when the legislation was amended in 2015, and it provided for Black fund managers to provide a Black ownership solution through their investing activities, it really was a catalyst for companies like Invequity to change the narrative and have a much more meaningful conversation, specifically or most importantly with multinational companies, and saying, hey, if you want to invest in South Africa, here's a mechanism to do it, which can not only bring about positive investment and capital contribution into the South African economy, number one, but at the same time can address your Black economic empowerment ownership requirements by participating in a private equity ecosystem. So my sort of overall takeaway for companies that are grappling with BEE, whether you're a South African-owned business or a multinational business, just having a deeper understanding of the legislation, and particularly how private equity is an enabler, really changes the narrative of BEE from this idea that it might be a tax into an opportunity. And we've seen Tumi and her team at Invequity have raised probably almost R1 billion worth of assets under management that are driving this positive economic story in South Africa. And so for me, it's a wonderful testimony of what's possible when people no longer wear this cap that says BEE is a tax, but rather it's an opportunity.
Oh, great, Murray. I like how you put it, that how we need to change the narrative, because from the negative one to more of a positive one, and I'm grateful that there are companies like Invequity that are leading that. And then one would ask, like, who would come? Someone like me who has less knowledge. But before I go into that, I just want to let our audience and attendees that are out there that if you have any questions, please feel free to put them in the Q&A, and Murray and team, they'll be grateful to answer them for you. And the second question that I will have for you with Tumelo and Murray is, how does the BEE legislation, right, encourage private equity investing, which later on Jeff will dissect about what is private equity.
You can.
Yeah, so I think what's worth knowing is if you dig into the legislation, and particularly the BEE codes of good practice, there's a provision in there that talks about the measurement of Black ownership or Black ownership recognition, which is a very important driver of the measure of transformation in a company. And the objective really is that at least 25% of companies should be owned by South Africans or Black South Africans. And that's nothing unusual. If you go to any country, if you try and set up a business in China, for instance, the local ownership requirements exceed 50%. Same if you do in Saudi Arabia. So this is not an unusual requirement that businesses have local ownership. And the Black economic empowerment legislation is no different. But what is really fascinating for me is that in the BEE legislation is a provision that allows for funds, private equity funds that are managed by Black-owned fund managers to be deemed to be like a Black person investing in the local economy. Now, why that's so important is that it means that a private equity fund where it's managed by a Black fund manager who makes the investment decisions and applies their thinking to what downstream investments they're going to be making, then those investments are deemed to be as if a Black person were making those investments in the local economy. And I think that achieves two major things. Number one, you're stimulating the creation of Black fund managers, because there's now a market for Black fund managers to be operating in the context. But the second, and I think more important and more subtle thing, is you now have people who have an understanding of the dynamics of what's going on in South Africa. So these clever people applying their minds about how to make investment decisions in the South African local economy. And for me, and the legislation enables that. And a lot of people don't understand that this is what BEE now does or stimulates. What the DTI is trying to bring about is to encourage Black fund managers to make investment decisions for the benefit of the South African economy. But I'm sure Tumi's got a lot more insight because this is what she does every day.
Yeah, so Murray explained and went into it quite in really great detail. And we obviously are on the operational side, where we are seeing more and more Black businesses come and ask for this funding. But I think the intention more today is to say that this works, right? So since our inception in 2016, I keep thinking 2017, but 2016, we have made investments of over 200 million, and this is growing at quite a high pace. And those investments have shown great returns and great results. We're very excited about the companies that we're investing in. We're very excited about the entrepreneurs that we're engaging with, because obviously as fund managers, we then also get involved in terms of governance, in terms of helping them with the best operating models, and also just opening markets where we can to them. We've also seen a growth. I think another part of this business that's been quite fulfilling for myself and the team has seen the growth with the clients that we deal with. So the investors into the different funds can come in sometimes very negative, as you've mentioned, that BE has been seen as a tax. So we have to spend this money, we have to do these things. But because we actually interact as partners now in the businesses that we interact with, we're able to have different conversations. We're able to point out the improvements and just the great things that the investments are doing. And in that way, also start educating different people about how great actually this piece of legislation is.
Thank you, Tumi. Before I ask this question about how equity investment, helps, companies, with their BE compliance, I think one of the key questions that someone might have is, what is private equity? So I think I'll be going to Jeff a bit, and then Jeff, if you could help dissect that, like, the history, the difference between PE and listed investing. Like, if we could start and dissect that, and then we'll come back, to talk more a little bit about how equity is helping companies. Jeff, the floor is yours.
Cool. So there's an old saying, and it says, it's an old Jewish saying that says, and I think it's many thousands of years old, that if you want to create wealth, you need to put a third of your money in your own business, what you're doing, or it's whether you're in your job or your company that you own, a third of your money in property, which you can obviously rent out or get income, and a third of your money in someone else's business. And private equity is about investing in someone else's business. I suppose there's two forms of the way you can access someone else's business. There's the model which most people are more familiar with, and that's listed companies. This is Anglo-American or ShopRite, Checkers, or companies on the Johannesburg Stock Exchange, or Apple in the States. And you phone your stockbroker and you open an account and you buy some shares in that company. And you own a tiny fraction of that company. And if that company does well, it will make profits and it will declare a dividend and it will pay some of that dividend to you. And over time, if it's successful, hopefully the share price goes up because the company's doing well. That's the model that people are more familiar with when we say investing in someone else's business. But actually, that's a fraction of the investment world. In fact, there are, from an account perspective, far more private companies out there, SMMEs out there, even large companies that are privately owned. So these are businesses that are either owned by the founders or the entrepreneurs that started them, or it could be owned by people that gave them some cash to help build the business. It could be owned by the management of those companies. But these are not listed companies. They would be, in our world, you could almost say PTY Limiteds, what we would know as PTY Limiteds. And private equity really is the market for investing in these unlisted or privately owned companies. If you think about it, stock market investing, while seems complex, is relatively easy to access. But private equity as an asset class, just because of the nature of the investments that you're making, is quite a difficult asset class to access. But simply put, private equity is buying into a privately owned business.
Thank you, Jeff. Okay, just to move on, Lionel, I just want you to know that we have noted your question. I will ask it to the panel soon. But for now, as we move on, before we explain about some of the risks that are there, I wanted to know a little bit more about equity, like how the investment model is made up and you know how you help companies with their BE compliance. If we can touch onto that, and then after that we're going to talk about some of the risks that are there when it comes to private equity, and then we're also going to allow Moses to come in and jump in, because Moses has a great story that he'd like to share with you about how Invequity has helped his business, and that's some of the great stories that we have today. But I will give Witumela the floor for now.
Okay. So how our model works is we obviously, as we've mentioned, receive investments from our clients, from the various investors. And in that way, the funds are set up in such a way that Invequity is the fund manager. As Marie alluded to it, Invequity is Black owned. It's Black owned and female owned and run. It is a fact that we are very proud of. And yes, we've got Jeff, who's the rose among the thorns.
Thorn among the roses.
But, so we basically get the funds in, and through our investment committee and pipeline of investment opportunities or deals that come across our table, we sit through a full process of due diligence. The other thing that just makes the Invequity model so great, also again, made perfect or made possible by the legislation, is that it isn't a donation, it isn't a loan, it's an actual investment that our investors are looking for a return from. So we still also consider it to be soft capital because it is part of legislative requirements. So Jeff and the team will sit and go through the pipeline that we've got, and we'll select certain companies. There are certain criteria that the companies that we internally will have, legislative wise, they do need to be Black owned, at least 25% Black owned. But there's other things that we'll look at. We'll look at the size, we'll look at the management team, we'll look at various criteria that just give us assurance as well that the team, that the business is a good business to invest in. Something else that's also quite unique I found in the market that we do is the businesses we typically invest in, not all of them, but about 80% of them are businesses that we are able to leverage. And when I say leverage, is use our networks, use our skills, use the different things we have at our disposal, different assets we have at our disposal to help that business go to the next level. It's always been cited that the thing that's holding businesses back is lack of financing or lack of money and all the rest. But we can solve that problem. But you know that you can solve my money problems, but if you don't solve my spending problems, then it's just never going to end. So what we try and do is we come in, yes, with the financials, but also we come in with back office support where it's needed, access to markets where it's needed, or just helping managers grow to become CEOs of a company that maybe used to turn out to have a turnover of 5 million. Now they're a 50 million turnover company. That's a different place. So we definitely try and help that. And that obviously then helps ensure that the returns that our investors, our clients are looking at and are looking for actually do get those kind of returns. And we also get to make our margin that we're in business for.
If I can embroider on the ecosystem, because to me spoken about the leverage, and I'll give you just 2 examples. So one example is if a multinational company wants to set up operations in South Africa, it implies that it's going to be making a fairly substantial investment in South Africa. Now, what we suggest to multinational companies, instead of coming into South Africa, setting up a PTY limited, and off you go to operate your business, your South African presence of your business here. Our suggested approach would be to say, set up a private equity fund, appoint a fund manager like Invequity. That would then mean that your private equity fund that you've established as a multinational to operate can make the downstream investment into creating your South African operating capacity. And what the legislation, the BE legislation says, as long as there's a co-investment into Black entrepreneurs at the same time, then your entire ecosystem, including your multinational operation in South Africa, is Black owned by that fund. So it's a very smart way for multinationals to deploy their investments or to capitalize their investments in South Africa. And obviously, there are a lot of multinational companies already operating here where we show them how they can effectively reverse engineer that structure so that they can achieve the Black economic empowerment objectives of the fund with an investment in their own operating businesses, but also this what we call a matching investment in Black entrepreneurial businesses. Now, so to give you just an example of how that might work, two of the investments that Invequity have made include a furniture manufacturing company and a artisan training academy. Now, what's interesting is the furniture manufacturing company will need artisans to operate the machinery. So now you've got two investments, one where you have a training business that provides artisans, and the other is a manufacturing business that needs artisans. And so you can see how this dynamic of what we call leverage, which is the success of this business drives the success of this business. They're completely unrelated. They have a common fund manager who can see this playing out and obviously makes investments that bring about these positive leverage factors. So anybody who's really wanting to build a business or empower a business in South Africa, a fund structure is a very smart way of doing it. And then having the right fund manager create an ecosystem unlocks this leverage, which helps basically the rising tide is what lifts all the ships. And that's the business model that I think is so unique to Invequity and why they've been so successful in the last 4 or 5 years that they've been operating.
Thank you, Marion Vitumela. Thank you very much. Because I guess you touched a little bit also on how multinational companies operating in South Africa can also benefit from Invequity's approach. But do you want to also maybe refresh and touch on it again? Maybe for for multinationals, they're like, okay, I really want to come in, and you're like, this is the reasons you should come in, and these are the benefits you will get if you invest with Invequity.
Yeah, so I'll just give you, let me paint a picture of how it can work. Obviously, we can't disclose the private nature of our clients, but we've got a number of multinational clients where this ecosystem is really working well for them. But just to paint a picture, if a multinational company operating in South Africa wishes to empower its local business, its South African operating business, with a Black ownership recognition from a BE perspective, in our fund environment, that is possible where the multinational commits capital to invest in Black empowered businesses. So what we do specifically, what we really be excited about is where the supply chain of that multinational has small or medium businesses that have Black ownership, that meet our Black ownership criteria. And the fund can invest in growing those SMMEs, and by virtue of growing them, they become better suppliers to the multinational, who is also part of this fund ecosystem. So the idea is that a multinational will capitalize a fund that will invest in its downstream ecosystem, these small and medium enterprises. And by growing these SMEs creates a demand for their products and services, which kind of guarantees the success of these investments. And obviously at the fund management level, the fund manager takes an equity stake in this entire ecosystem, which brings about obviously improved BEE credentials for both the multinational and for the SMEs. And in doing so, you can see how we can stimulate jobs, growth, economic development, and the growth, hopefully, and we're starting to see it happening now, the development of Black industrialists in these supply chains of these multinational companies. And that's kind of the secret sauce of Invequity, and what we bring to the market is this ecosystem which kind of feeds on itself to create economic growth and the development of Black entrepreneurs.
Thank you very much. Moses, your turn is about to come now. you're the only one who have not yet spoken, because we know like Invequity helps, it helps South African businesses, and you are one of those businesses that Invequity has touched and has been able to help. Can you explain the role that it has played for your organization and for South African businesses? So The floor is yours, Moses.
Okay, cool. There's so much to say about integrity. First of all, personally, before maybe I talk about like what it has done to the company, based on, for example, coming from an unfortunate family background and growing up in a destitute environment as a Black person in South Africa, it's not necessarily an easy task to get oneself out of those kind of situations and make a difference to our nation and consequently maybe to the world. So Invequity to me, it's a private equity investment flagship that has proven itself to caring and nurturing Black businesses that have a potential of becoming multinationals. So personally, that's what I could say about like how Invequity has uplifted or transformed me. So before I talk about like what the benefits of the benefits of Invequity to Riot, let me explain a little to you about like what Riot is and what we do. So Riot developed network technologies that enable households and small businesses to deploy and operate broadband infrastructure in their own neighborhoods. The Riot approach is the model that we have never seen before implemented in the broadband access business. So that simply means this is quite a unique thing about Riot. It's different from the kind of like broadband access businesses that we have seen because we have never seen that done before. Riot is also proving itself to becoming the #1 preferred choice of broadband access to the communities in which it operates. So right now, as I speak, Riot is in its pre-commercial state, and we could never have reached this far without the support of Invequity. And when you're looking at the benefits that Riot draws from Invequity, I mean, Invequity has financially enabled Riot, and in situations where like it's not a norm to do so, it has financially enabled Riot to keep its businesses thriving in situation where it's not fashionable for private equity investment companies to do so, which really changed the game for Riot in terms of how it perceives what a private investment equity fund is. And that really sets Invequity to be different from what we know equity investment companies to be about. And then not only is Invequity enabling Riot to reach its goals financially, but the support that Riot draws from Invequity related services. I think Mari touched on one of like those things in terms of like he made an example about a carpentry company and how it draws from a training company that Invequity invested in both of them. So I'd like to make that example, and this is the difference of what this is how I'll view. This is how Invequity set itself out to be different from other private investment equity company, because when you look at Riot, yes, Invequity invested in Riot, and then we were sorted financially, but there was a lot of stress and time that we were spending in things that had we known before, we could have just thrown this to Invequity. And for example, one of the companies that Invequity invested in has a shared service service that it offers, and that has alleviated a lot of stress that Riot was experiencing and wasting time on for a fraction of the cost of what many other companies could do. And this is where really like the crust of like this thing is, or the difference is, because I mean, you look at Invequity, it has invested in Riot, it has invested in these companies that offers Riot shared services, and it cares about both companies, you know. So you can be sure that like the service that you receive from the shared services, you're not just, you know, having this, you know, cloud services companies that necessarily don't care about your business. You know, you have this shared services company that actually cares about your business, because both of them, they feed from the same master, which is Invequity, and this has really made a huge difference, because when you look at what shared services has done, I mean, like, it has enabled Riot to focus on the technology that is developing and worry less about human resource, financial, and legal tools, just to mention a few. And these tools were a catalyst to Riot in being efficient and effective in its business. So yeah, that's what Invequity has actually done for.
If I may, Thabisa, I just want to interject, because Moses is completely underselling himself, and that is, I just want to read this to you. Riot has been nominated by the Department of Communication and Digital Technology to be showcased at this year's Dubai Expo in March 2022 as a recognition of the incredible technological developments that they've made, and how they are transforming people's lives in poor and rural communities with access to the internet, basically. So Moses and his team have done amazing work, and I'll continue to do so.
Man, amazing. If I had like sound effects, visual effects, I would be popping up on the screen right now. They'll be popping up on the screen right now. So all I can do for now is
exporting its talent and its innovations to the rest of the world very soon because of what Riot is doing. So yeah, I'm very chuffed for what they do.
And thank you to Invequity for also playing a role in that, and thank you to Riot. Moses, go on.
I was just saying, like, in terms of like what Mari's closing argument was there. I mean, when you look at the issue that the problem that Riot is solving, it's not necessarily a South African problem. It's a global problem, you know. And then if we can solve it first here, and then hence the saying that, like, you know, we have that potential of becoming a multinational, because the problem that we're solving is global, and then it's not a unique problem to South Africa. I was just like adding on to what Mari was saying.
Thank you, Moses. That's actually true. You know, start at home, and then if you're solving a global problem, you're commercially viable forever. Also, Jeff, I wanted to come back to you. I'm so sorry. I'm so sorry, but I wanted to come back because we're talking about like private equity. We're talking about investing, because like the next question that I wanted to ask is about like equity investment strategy. But before we asked about the strategy, like what are some of the risks that are that are there around private equity investing? Like if you could touch like some of the difficulties of PE investing, like private equity investing, it would be really great. And then if you can expand it in layman's terms for someone like Tavi, so that they can understand it. Thank you.
Cool. So I suppose the risks of private equity are all about information and understanding and knowledge. So if I'll draw the parallel again, if you wanted to go and buy shares in a company listed on the JSE, you could probably go and read the annual report because it gets published. There's a price that's set on the JSE because people are buying and selling shares all the time. So there's a reference price. There's a market there that there's actually where you can actually put offers in to buy the share or sell the share if you want to get rid of it. So there's liquidity. And because there's liquidity, you can see what the buyers are selling at and the sellers are buying it or selling it, and you can get a price. Let's call it a price discovery. And then you can say, well, I think that this business is worth more than the current trading price. The share is trading at 10 Rand a share. I think it's worth more. I'm going to buy some shares. Now, the problem in private equity investing is that none of this exists, okay? Because you're dealing with someone, probably the founders or the managers, the current shareholders of the company, don't have to publish their financial statements. Even if you saw a company down the road, the local, the local garage, and you wanted to buy a share in that, you'd have to find out who the owner is or who the owners are. Then you might not even get the financial information. They might not want to sell. How do you value the business? Because there's no reference price. Even if you could value the business and you manage to find a seller, like there might be two partners in the business, and the one partner says, look, I want to go and retire, I'll sell my shares to you as a private investor, you become the shareholder. How do you, as that investor, protect your rights? Because often a private equity investor is a minority shareholder, so they don't own more than 50% of the shares. They might own 10, 20, 30% of the shares. Now, when you're a minority shareholder, it means on the other side, there's a majority shareholder. Is that majority shareholder going to treat you fairly, or they're going to look after themselves first? So how do you make sure that you're protected in this? And then one of the other problems is, well, that let's say you've identified the business, you managed to buy into it, you've got a valuation, you're happy with your protection, your shareholder rights being protected, and you own it for a few years, and then 5 or 6 or 7 years later, you need to sell the business. Okay, sell your shares in the business. Who are you going to sell it to? How do you find a buyer? How do you find the right price? So all of this makes it. You might laugh when I say this. Anyone that's bought shares on the Johannesburg Stock Exchange, well, that's actually, well, they claim it's simple. It is a bit complex. You've got to open the account. You've got to be figured. You've got to put the money in. But if you think that has slight hurdles to go through, wait till you do this in private equity, and the hurdles are running thousands of times more complex. So it's an incredibly, what we refer to as a user-unfriendly asset class. And so all of these problems around the user unfriendliness are what we almost term the risks of private equity. And so what the solution is, and what the industry does, the private equity industry does, is that they try and solve this problem for investors. So obviously, whenever there's a problem, there are companies that are willing to step in and create that solution. And so the traditional private equity solution is that a private equity fund would go to investors, and different individual investors, that could be companies, that could be pension funds, and they say, give us some of your money and we will put it into a pool of assets, a pool into a fund. And let's just say that there's 50 investors and there's 100 million Rand in that fund, 2 million Rand each. That fund now sits on 100 million Rand of capital. And what it does is it goes and it does the legwork. It finds and sources the transactions. In our world, it's finding awesome, fantastic businesses like Riot, doing the due diligence, doing the valuation, putting money into these businesses to help them grow. Offer, and some, not all, but in some cases, the private equity funds also offer guidance and mentoring or the ability to help facilitate growth in these companies that they buy into. And so the fund itself is sort of sits here with its pool. It's got this 100 million Rand cash. It's allocating, it's monitoring the investments. It's declining investments. Remember, just because you knock on the door and say, come and invest, we need your money, as you go and knock on the fund's door and say, please give us some money, doesn't necessarily mean you're going to get it. And then obviously at the end of the investment period, maybe 5-7 years, the fund itself will look to sell that investment, or it could retain it depending on the nature. And it would find buyers and negotiate with the management team. And so that's what the fund does. And normally what happens is next to the fund, you get the management company. So remember, the management company doesn't own the fund. The fund is owned by the investors, the capital suppliers at the top. But the management company is the team that is the firm that actually is running and looking after the assets in the fund, deploying the investments, monitoring the investments, and ultimately, hopefully, disposing of those investments at a profit. And when it disposes of those investments at a profit, it returns that capital plus some back to its investors. So I hope that kind of makes a little bit of sense, and that gives
Well, if I may, Tabisa, what I'd like to do is give a practical example of how that's really happening. Because about 6 months ago, I approached to me to say, listen, our company Signa has about 300 or 400 clients that we advise and try and help them with their Black economic empowerment. But they're not all these big multinational companies. A lot of them are small and medium-sized businesses. I said to me, is there a way that we can provide an ecosystem, a fund ecosystem for these smaller businesses to also participate in investments like Riot, for instance? And so they came up with this very cool idea called the Let's Grow Fund, which I'm very excited to, and I promoted to all of my sort of smaller clients, which is basically says, listen, for making, I think it's about a 9,000 or 10,000 Rand a month investment, you can actually participate in this ecosystem. And at the same time, you can bring about Black economic empowerment in your own business, but participate in investments like Riot. And as Jeff mentions, you could be one of a whole bunch of small investors making a small contribution every month, which builds this fund. Well, it's called the Let's Grow Fund. I guess that's a great name for it. And together, what happens is we pool all of this funding together, and then can go and look for exciting investments, specifically exciting Black-owned businesses that are needing capital to grow. So I'm very excited about this new fund, and every opportunity I get, I talk to my friends, my clients, and the businesses that they operate. Because for a small sort of monthly installment, as it were, you can participate in this ecosystem, solve your own Black economic empowerment challenges, and then be part of these exciting investments. So I'm looking forward to see what happens with the Let's Grow Fund.
I'm excited. Hopefully you'll keep us up to date, because I believe everybody who's attending would be really, really interested to know more about the fund. And having said that, the next question, I just want to ask Jeff, and then I come to you with Dumelo with the question. But I also want to note, with Dumelo and also Aliza, that I have noted your questions. I will ask them to our panel. I just wanted to ask, the first question is, how can investors access the private equity, Jeff? And then after you elaborate and share with us how someone can access the private equity fund or the private equity, and if Dumelo can also jump in and explain to us, how does equity investment strategy work? What is the equity investment strategy? So, and how it works, and how it, because we already answered how it helps South African businesses with Moses. Jeff?
Well, on our side, just very simply put, if there are investors out there, whether they're individuals or foreign multinationals or local companies, is obviously just to contact us, and they would subscribe into the fund. So they would make a cash contribution into the fund, whether it's a monthly basis or a recurring amount or a one-off, and they would essentially become unit holders that own a slice of the fund to the value of their contribution. And obviously, if over time, if the value of the fund rises, the value of their investment in the fund will rise. So and obviously we have slightly different funds, as Murray alluded to, but it's a relatively simple and easy process. But I understand part of my role and the team's role is to invest some of that money. Tumi is much better at answering the question of actually how you access the fund.
So if you'd like to touch a little bit on that. Details of our contact details have been shared and will continue to be shared. You can also go to our website. If you've got some great business proposals for us to look at, we always welcome those. But what I can say is, and also just help you to touch on your question to me directly on our strategy. Our strategy really is to help grow businesses, to help grow South African businesses to their full potential. We today have Moses here, who was just one example of one of the, quite a few of the investments we have that we really see big things coming from them. So in the case of Riot and one or two of our other investments, we got in at the pre-revenue part, but obviously we had done quite a bit of work in terms of the due diligence. So once again, just because we get a proposal on our table doesn't guarantee that we will invest. We do look at quite a few things. We need the business to be exciting, because we're the size that we are, we take really, I want to say, like a personal interest. The businesses we invest in, all of them I can say, are businesses that we're excited about. Murray mentioned the artisans, he mentioned the artisans and training business. We've got a business that also installs lights. One of our clients is in the lighting business, and they have invested in that through us, and we're seeing that business grow. And so our strategy and what we look for, our vision is for visionary leaders who have solutions for the South African economy and market, and then also the ability to grow that. When we look at, when Jeff does some of his due diligence, one of the key things we always look at is, what is the growth trajectory of this business? So we're going to come in. We've mentioned before that we offer whatever assistance we can. And with that, how will that business grow and scale? Scale is a very important thing. And again, because we're private equity fund investors and we've got investors looking for a return, we look at, yes, the dividend policies, yes, the returns on investment, but also exiting that business. Will it be an exit that is beneficial to everyone? In our short life, we have exited, I think, 2 businesses or transactions that actually matter in size. And we're very proud even of those exits, because we managed, yes, to make a return, but also to exit into Black players in those industries. So we had a medical equipment company that we exited, and we had another fund, a Black-owned fund manager, exit us. We've had another company exit us, and they were also taken over by management who were Black. And so we, in keeping in line with the outlook for transformation and growth of South African businesses and people, like Moses was talking about, this is part of our strategy. That is it, in business terms, we call it high impact. That's also something that we look at. That is this business also high impact socially? So will it create jobs? Will it solve a social problem? And at the same time, make returns for our investors.
Thank you, Itumeleng. I guess I would come back to you, Jeff, and ask, what types of returns can investors expect when they invest with Invequity?
It always comes down to the numbers at the end of the day.
Yes.
So maybe I'll talk about the asset class as a whole, and then maybe we can talk specifically about Invequity. Over time, the average return for listed company investing, if you buy a stock exchange, if you buy the all share index and own it for 10, 20 years, the Johannesburg Stock Exchange or the New York Stock Exchange, the Dow Jones, typically investments in the listed space on average earn around inflation plus about 6%. That's like a long-term goal in that space. In private equity, the range can be higher or lower, and it really depends on what your objectives are. So you get some private equity funds that are just purely return driven. And the rule of thumb there is that they would try and do inflation plus 8 or 10%. Sometimes they do better, sometimes they do worse. Remember, these are objectives. But you also have firms, private equity firms that are looking to make an impact as well. So, and an impact doesn't necessarily mean that you actually have to sacrifice returns, but what it means is that you are balancing your impact, whether it's environmental impact or, in South Africa's case, transformative impact in terms of transforming the economy. It could be governance impact, social responsibility impact. And so generally when we are looking at investment allocations, we're trying to balance those impacts. Now, they often talk about triple bottom line reporting for corporates. In a way, we're trying to look at multiple return drivers. Our return on investment is that we want to get a decent return for our investors, inflation plus something for our investors. But at the same time, in other words, the capital at least stays with inflation or grows faster than inflation over time. But at the same time, that there are other impact drivers out there, social impact, whether it's from a transformation perspective or like the massive social impact, for example, in Right's perspective. So as Right rolls out, the ability to deliver essentially free internet into poorer and rural communities in South Africa in particular has massive impact. But now how fantastic that not only can you have that impact, but you can make money from it. And I suppose our view is that actually impact and returns are not opposites. They actually complement. In fact, if you're getting impact, you can actually create fantastic returns as well. But what that does mean is that when we make our allocations, we don't just look at chasing the returns. And often that means is that you're looking at a longer horizon. Businesses that are just chasing near-term profits might turn the profit. But when you're looking at impact investment, you have to be a little bit more patient. So typically our returns are inflation to get your money back, plus a decent compensation or risk compensation for the risks you're taking.
Thank you. Thank you, Jeff. I guess before I ask one of the questions here to Murray about like what about small enterprises and micro enterprises, does Invequity have a solution for them? But asking that question, I will also start asking the questions from the audience. Sibweng also had a question. Sibweng Musia says, does Invequity only help existing businesses or startups as well? So I think those two questions go together. Marian Bitumelo, the floor is yours.
Cool. Well, I think Invequity's track record demonstrates how effective they've been in identifying really good small and what we would call small and medium enterprises that have a very positive growth trajectory and meet certain criteria. For instance, they are partly Black owned and they have a high social impact because I think one of the things Invequity is really aiming to do is to move the socio-economic needle in this country. One has to question whether, for instance, making an investment in a property company stimulates socio-economic growth. There's nothing wrong with property investments, and as Jeff said, at least a third of our income should be there. But that's not the focus of Invequity. The focus is really to invest in those companies that are going to bring about some kind of socio-economic impact. But how does that work in our environment? Well, if you understand the model is that we go to large companies like multinationals or even smaller companies through the Let's Grow Fund. We raise capital. This capital is then cash that is available to invest into qualifying investments. Now, as Jeff mentioned, private equity, you have to go through a due diligence process and make sure that your business meets all the criteria, including some of these criteria like black empowered, high social impact, etc. And then if you think of it like a funnel, you have lots of people are interested in getting money, but not so many businesses will qualify. So you go through this sort of funnel process till eventually you get to a point where the investment committee of Invequity says this is a good investment, and we are now prepared to take our clients' money that they've put into this fund and invest it into these businesses. So that's how the model works. Their track record, is really good, and I think Jeff's been underselling how well the portfolio has been doing, and so any business that meets those investment criteria would go into the funnel for consideration. And if you get through all of those sort of selection criteria, and you're ready for a capital investment, then that's when the Invequity would deploy capital and then come and be involved, and the involvement would be things like sitting on the board, helping with governance, helping with access to networks, helping with this leverage that we spoke about, so that they can help to create the success of that investment. To me?
Yeah. There was also a question around individuals, how do we help micro businesses and individuals and EMEs? And I think just as a general, or a little bit out of the private equity conversation now, as a general principle, if you have an idea and you want to start a business, I would say start right? Because we're a private equity fund, we need to invest in a business. We ourselves are entrepreneurs, yes, and that we started in equity, but we are not in the business of starting businesses. So start your business, get a track record, write things down, have a history, so that when you come to equity, there's something that we can work with. And we've been speaking about it all morning, that we are definitely always looking for those diamonds in the rough. We are looking for those businesses that typically someone else may not look at. We'll look at, you'll still go through our criteria, but we've had businesses, Marie, that have come in and at face value don't qualify. Like, we actually can't look at it. It's not bankable. It's not all the rest. But upon further investigation, because we are interested in what that business has to offer, maybe we do see some synergies with some of our other investments or some of our other clients, we can take a second look at it. So we definitely have offerings for your more micro businesses, but like I said, I think put onto it and move. I know that sometimes in the past where we haven't been able to help a business, we've been able to refer them to someone that we know could possibly be in their space and would be more interested.
Thank you, Vitumelo. Moses, the floor is yours.
Yeah, just to amplify on what Tumi has just said in answering that question. I mean, you look at where Riot started, from how it started as an idea. I mean, there was no business, but then there was idea and technology to just a minimum viable product to prove that this is what we talk. So when she says start, bring up something, even if it's not in the market, but then bring up something that you can explain as to what your business is about, and then what's its viability in the market. And yes, there's going to be that due diligence that has to be done, which might take some time until maybe they invest in your company or something like that, which was the case with us, that the due diligence that was done for Invequity to invest in Riot was really hardcore. I mean, it really took some time. So yeah, I'm just amplifying on Tumi's point of saying just start, Yeah.
Thank you, Moses, for that point. I really appreciate it. And as you can see, for everybody attending, Moses started, and today he's here with us on the panel. If you start, you could probably join us on the panel next time. And just to go on, because there's lots of questions that everybody is asking. Vitumelo had about 4 questions, and I think everybody can get a piece of the pie and answer one of the questions that really would apply to them. I'm not sure if Vitumelo is a he or a she, but Vitumelo asks, how many investments can a partner have active at one time? The second question is, what is a typical board composition? And then what role will a person play in the relationship during and after the transactions? And what is a great return profile and strategy of these companies? I think the last question is actually for Jeff more than anybody else, but the floor is yours.
So I think so another thing that I just needed to understand, but I'll just answer it generally, is on which side of the divide are we talking? Because we've got partners who are our investors. So for our investors, they can have multiple businesses, right, that come in and take up the solution. We do have clients that I think have got 3 or 4 businesses that they have put under the fund structure, and then they're also investing. So our partners really can invest and can participate with as many as they need. The other thing that we will do is obviously engage the client and see where the need is for our structure and make it applicable and appropriate for them. Typical board composition. So as a fund manager who's managing the fund, our real interest is just in seeing that the business is being managed and run correctly, appropriately, and for the benefit of the business. We, in most cases, especially on the investment side, we bring in that governance skill that one of our service providers like to say, differentiating between the shareholder, the director, and the executives of the business. So that's some of the excellence that we will bring into the businesses at different times. So board composition is really dependent on the client, dependent on the investee company. So that's always dependent on the situation. And then the role that the person will play, again, it's up to the client, especially on the client side, it's up to them on what role they want to play in terms of the investments. We do try and make our clients' lives easier, and that's why we are managers, and that we try and manage then the investments, especially the investments in the Black companies. We sit on the boards, we try help wherever we can, give expert advice, and then we report quarterly to our investors in terms of how their investments are doing. Jeff, target return profile and strategy.
Maybe just for clarity, in case some of the our viewers might to understand the difference between a client and an investee company. A client would obviously sometimes be a multinational or a corporate that is looking for a BE solution, which is part of the ecosystem. And we may also then invest into those client companies as well. Similarly, though, we're also raising the capital to go into qualifying investments, which would be Black-owned companies that are seeking growth capital. And those are the more, in our world, more exciting opportunities. Those are the rights. That's the future there. So in terms of maybe talking about those investee companies, the return profiles, it really depends on the life cycle of the business. So if I could almost, I know that the textbooks talk about 5 parts of life cycles, but I'll talk about 3 just to keep it simple. The first one is the early phase or pre-revenue life cycle. So you've got an idea, you've started your passion project, now become a bit real, you're running it from the backyard, you know, or it's becoming real, but you haven't commercialized it yet, and you're looking to grow it. Clearly, if you invest at that point, your risks as the investor are much higher because there's a lot more that can go wrong. You've got a proof of concept, but to build the business, build the clients, build the revenue. And so therefore, expected returns, we would hope would be higher. Our hurdles would be higher in those types of environments. Let's say that's the sort of first case. The second type of life cycle would be companies that have gone past startup and they're in a growth phase. So now they're actually growing quite strongly. They've got clients, they've got some revenue, they've got a proven proposition, but they want to grow their footprint. And often companies want capital inserted or invested at that stage to fund that growth. And clearly then you'd be looking at, because of the proof of concepts being done, our targeted returns might be a little bit lower there, say 15 to 20%, that you'd be comfortable at that level because you're getting compensated at that point. And then obviously you would get what we call mature companies. So these are companies that are really established, they've been around a while, they're still growing, but they kind of, they're not growing as fast as your middle phase. But there's more certainty around those. So they might be looking for a little bit of capital. Maybe 1 or 2 of the founding shareholders wants to sell or take some money off the table. They don't want all of their eggs in their own business, as their eggs in one basket. They want to actually diversify their own balance sheet slightly. So they want to sell a little bit of their business to someone else. And therefore, because that business is in a more mature phase, there's more certainty. Obviously, the returns that we would want to get out of that business would be lower. So from a return profile, it really depends on the life phase of the business that we're investing in, and the potential and the risks associated with each of those phases. But I mean, yeah, we're more than happy to take these questions and conversations offline as well.
Oh, thank you. Thank you, Jeff. Moses, let me give you the floor first.
Okay. Just to add on what Tumi was saying, and based on Witumelo's question 1, how many investments can a partner have active at one time? I mean, from my experience at Riot, having Invecquity as a partner or as an investor, they actually go all the way to actually finding other partners who can actually invest in your business, but then not only bringing in a partnership in terms of like finances, but partnership in terms of like other expertise that Invequity might not have at that point in time. So you might have company B, it's willing to invest into Riot. Invequity might source that company and say, come and invest in Riot. But then the only thing that you're bringing in, you're not only bringing in finances, you're also bringing in expertise, 1, 2, 3, 4, 5, that might be lacking within the company, and Invequity might not be experts in that. So just to add on what she was saying, I think like you can have probably as many partners as you have to invest, depending on what they're bringing to the table.
Thank you, Moses. Thank you for everyone who has joined us. And I know there's lots of things that we would love to talk about. We could go on forever. But just to close off, I would like to ask each and every one of you the last thing. Like, Mari, if there's one thing you'd say is a key takeaway that you'd want for the multinationals who wants to invest in South African businesses, what would be that key takeaway? We do Dumelo, for small enterprises or businesses that want to come and work with you, what would be their one key takeaway? And Jeff, when it comes to you, we talk about money because numbers. If there's one key thing that you can say, if you do this, you would see great returns for your business, especially when you come to Invequity. And then Moses, to also, if you can share, like, if someone wants to do business with Riot, how they can reach out to you. And then finally, Tumelo will share her final remarks on behalf of Invequity, and then we will close off. The floor is yours.
Thanks, Tabitha. I think for me, the closing comment would be that in the ecosystem that Invequity has created, it is an unbelievable place for multinationals to bring about investment into South Africa and into their business that's operating in South Africa, and to participate in this new asset class, transformative investing. And if you can see the results that this team of Invequity is generating right now, it's an incredibly exciting asset class, and the multinationals themselves can resolve one of their biggest challenges, typically, which is Black ownership recognition for their own businesses. For me, that's the best takeaway, is that it's a win-win. We're bringing foreign direct investment into South Africa, stimulating the local economy, developing our future Black industrialists, and Invequity have got it all right in this ecosystem. So I'm very excited about the future for them.
Thank you.
So if I speak to small businesses that we work with, or we potentially would be interested to work with, I've already said that, start, push, hustle, do what you need to do to build your business and that track record. But I think also one of the things that I found is quite important in the entrepreneurial journey is planning and thinking about what you want. So it's very easy for an entrepreneur to say, oh, these guys are going to give me 10 million, I'm taking it. If you take it, understand that you're bringing in a certain kind of a partner into your business. And so if you haven't planned and thought about what your business looks like, you're going to take this partner on that might not align with your values and what you want to do just for the money. And yet, we've spoken at length about Invequity and our principles and what we stand for. Is that something you want to do? I do also want to reiterate that I'm very passionate about the space. The business is going, it's fulfilling what we had come to do, what we had come together as the shareholders to try and do, to just change this narrative. So absolutely, we're looking for more partners. We're looking, even for, Mary mentioned that we've got a new offering, that's the Let's Grow Fund. So for your smaller white-owned companies to come in and be part of this ecosystem, and more than just get their ownership or their Black ownership credentials that they need, to be part of actually doing good for the country.
Jeff?
My little bit of advice would be to any entrepreneurs or business owners that come to us, but I actually think just as a business advice, is you've got to know your business DNA. And what I mean by that is you've got to understand what makes you different or unique or special. Even if you've got a business that looks like that there's many similar competitors. In other words, understand what makes your business tick and what makes your business different to your competitors. Now, Right's fantastic because Right's actually unique. So it's made its own space. But a lot of businesses have got lots of competitors. If you're running a garage down the road, why is your garage different from others? So actually know what your differentiating factor is, know what your DNA is, and be able to articulate that, be able to explain that. Maybe to say is that I think often you get entrepreneurs that kind of have an idea or they've started a business, but they're actually, they're not necessarily just looking for capital providers. They're actually looking for solution providers. Someone's going to solve their problem. And capital providers don't always have that. And we try and get involved in that, but but you need to understand what you are about and what makes you special and what makes your business tick and why your business is going to succeed versus others. And I think if you can understand that yourself and you can explain that to others, and you can then implement that in the way you run your business, I think you're hopefully on a winning form. I shouldn't say hopefully, you're on a winning form. Not hopefully.
Thank you. Moses, last words, and then Vitumela can close off for us.
Okay, cool. High impact. It's one of the words that have been thrown around today, and it's been explained as to what a high impact business is. It's actually one of the key points of what a high impact business is growing the economy, creating jobs for people, while you're making money, of course. So if you want to become partner with Riot, I would suggest that you buy Riot equipment and roll it out at your own communities, because what Riot is, it's a community network. It's a crowd-funded network whereby the people who buy this equipment. So if you buy this equipment from Riot and then put it around, number one, you are making a social impact to your community. Before, let's say all these people are paying you. By just putting down that infrastructure, you're making a social impact and you're making money out of it. But then the people in which are operating this for you can actually make money out of you as well. So you see, you're creating jobs for these people as well. So that's one of the key points or takeaways of what a high impact business is. So with Riot, because we are right now in our pre-commercial state and rolling out these networks, the best way to collaborate with us is to buy a lot of our equipment and then install it.
Now that's a true entrepreneur, right?
That's a true. And I think I gave him the most important advertising space. I'll send you an invoice afterwards. But before Vitumela goes, I just want to let everybody know that we'll be having another masterclass on the 16th of March at the same time at 11 a.m. We look forward to seeing you there. And I just want to thank you, Mare, Vitumela, Moses, and Geoff, for joining us on this platform. And we really, really appreciate, and we hope you learned a lot. And let's go out there and inspire the world to do good business. And Vitumela, you can have the last word and we will close off. Thank you, everyone.
Yeah, I also just want to say thank you so much for your time. Thank you for listening to this bunch of entrepreneurs. And that's why we work so closely with entrepreneurs, because we also had a vision. We also had a thought of what to do. And we were interested in different aspects, but we were able to bring it together. But I think if we've achieved one thing, for me, or if we can achieve one, if there's a big outcome from this session, would be that transformation is not a tax, should not be thought of as a tax, but something that is vital to make sure that this economy grows. We sit in a world where you have only 1% of the world population that is rich or is able to make it, or whatever the stats are. And we all know that's not sustainable, that can't be. So let's not let South Africa be part of that. Let's try and close this inequality gap. And how do we do that? Investments from those that have, and then making those investments work. So it's not donations, it's not things like that, but it's making them work with people like Moses, like our other entrepreneurs, making those investments make a difference in our country. We just want to be that one that makes that tick, that makes that extra difference to get us across the line. Thank you so much, everyone.
Thank
Bye-bye.
you. Bye.